Hello, this is Leroy Meadows, and welcome to this session. And today we're going to deal with Chapter 7, and we're actually going to split this chapter into two different segments here. So this is part 1. We're going to talk about the flexible budget and direct cost variances, and then we're going to look at, in the next video, the journal entries associated with those cost variances, and then management control. And how does the flexible budget and comparing our actual results to our budget results, what does that do for management control? So let's go ahead and get started here. First of all, we're going to understand static budget and static budget variances. Second, we're going to examine the concept of a flexible budget and learn how to develop it. We're going to calculate flexible budget variances and sales volume variances, and we are going to talk about and explain why standard costs are often used in variance analysis. We're going to compute price variances and efficiency variances for direct cost categories. And then next time, we'll talk about understanding how managers use variances, along with the creating journal entries, and then describing benchmarking and explaining its role in cost management. So let's talk about some basic concepts. Well, first of all is a variance. And a variance is just simply any difference between what we actually come up with, what we actually do, our actual results, and the expected budget performance. Management by exception is a term I know you've heard in other management classes and stuff like that. This is the practice of focusing attention on areas not operating as expected or budgeted. Doesn't mean we completely ignore areas that are operating as efficiently as they are expected. It just means we shift a little more focus to the areas that need improvement and a little less on the areas that do not need improvement. We have a static budget, which is based on the level of output planned at the start of the budget period. When we created our budget in the last chapter, we had to pick a level of activity. And then based on that level of activity and the number of units we planned on selling, we created the operational budget, and then we also created the financial budget. But the static budget is going to be the operational budget. What is our budgeted level of output beginning at the beginning of the period? A static budget variance is just simply the difference between the actual result and the corresponding static budget amount, or a master budget. And what you'll hear me do is you hear me say static budget and master budget. Those two are interchangeable. For our purposes, those two terms, whether static budget or master budget, those are going to be interchangeable. We have the term static budget because it's fixed at one level of activity, and that's why we refer to it as a static budget, but it's really the same thing as the master budget. When examining variances, we're going to look and see that when that particular line item and all else is considered equal, does that variation or that variance increase operating income, or does it decrease operating income? If one line item taken by itself with all else being equal, if it has a positive effect on operating income, we talk about positive effect, obviously we're talking about increasing operating income, then it's a favorable variance. So was it unfavorable variance? Well, that's the opposite of the favorable variance. Unfavorable variance has when we take that one line item and we view it in isolation, and assuming that all else remains equal, that one line item, that variance is decreasing operating income relative to the budget amount. So let's go ahead and get started here and start talking about variances themselves. We can start out at the top with a level 0 variance analysis. It's just really nothing different, just noting the difference between actual and static budget variance. Now, levels 1, 2, and 3 examine our different levels of examining. With level 1, we get a bird's eye view. With level 2, we get a closer view. of the variances, and level 3 we get deeper into the details. So level 1 analysis is just simply the static budget variance. And the static budget variance is simply the difference between the static or the master budget, what we planned on doing before the beginning of the period, and what we actually came up with. What were our actual results at the end of the period? At the end of the budgeted period, how did we compare to our static budget? As you see here in this illustration, we have an unfavorable budget of $93,100. We calculated the static budget variance for each individual line item. And how do we get that? Well, we simply took the difference between our static budget and our actual results. So when we talk about favorable and unfavorable variances, let's take a look at this. Let's take a look at the line item units sold. Units sold, our budgeted amount was 12,000. However, we only sold 10,000. So assuming that everything else outside that one line item remains equal or goes according to plan, what is the change here? How we have a 2,000 unit difference. We're assuming that assuming all else is equal, selling less product will cause a downturn in operating income. Let's take a look at the line item for revenues here. Our static budget generated total. We were going to generate $1,440,000 worth of revenue. However, we actually sold and earned revenue of $1,250,000. So what's the difference between our actual results and our static budget? $190,000. And it's unfavorable because all else being equal, that $190 of less of revenue is going to make us have decreased operating income. Now let's take a look at variable costs. Direct materials. We were budgeted to have $720,000 worth of costs associated with direct materials according to our static budget or our master budget. However, we actually spent only $621,600. So we spent $98,000 less, $98,400 to be exact. So let's take a look at the variance here. For direct materials, all else being equal, a reduction in costs should lead to higher operating income. So that's why that variance is favorable. Let's take a look at direct manufacturing labor. We budgeted for $192,000 of direct manufacturing labor. Our direct manufacturing labor actually came in $198,000, so we were $6,000 over in cost. If we run over in cost by $6,000 for direct labor, what is the impact does that $6,000 have on operating income? Well, all else being equal, that $6,000 is going to reduce operating income, so that's why it's unfavorable. Same with variable manufacturing overhead. We came in $13,500 less than what we budgeted for of $144,000. So all else being equal, a reduction in costs is going to positively affect operating income. Then let's take a look at the line item for, let's skip down here to fixed costs. Our fixed costs, we budgeted for $276,000. However, we came in at $285,000. So our fixed costs came in $9,000 higher. All else being equal, higher costs leads to a reduction in operating income. Now what I'm going to do is I want to take the net effect of the unfavorable variance of revenue, unfavorable variance of direct materials, direct manufacturing labor, and variable manufacturing overhead to get my contribution margin variance, static budget variance. And from that static budget variance for contribution margin, I'm going to subtract out my fixed costs static budget variance, and that will give me my static and then that will give me my total static budget variance of $93,100. So let's talk about a flexible budget. A flexible budget calculates budgeted revenues and budgeted costs based on actual output. So we're taking our budgeted revenue, our budgeted sales price per unit, multiplying that by to get what we call a flexible budget for revenues. Same thing with costs. We have flexible, but we take our budgeted amount for direct materials, times that by the number of actual units we did, and how many actual units we produced and sold, to give us our flexible budget for direct materials. And we do the same thing down the line here for each line item. Now, the flexible budget is prepared at the end of the period, after we know actual output. Why is that? Because then we can create that budget that we would have created if we would have known how many units we were going to actually sell. When we're creating the master budget, do we know precisely how many units we're going to sell? No. Do we know how much our direct material costs are going to be? No. We can plan for a certain cost, but then there might be some unexpected things that come up. Maybe we sold a lot more. Maybe we sold a lot less, but our cost came in less also. Or maybe we sold more, our cost came in less, or maybe we sold less and our cost came in higher. There's a number of different uncertain factors that we have to look at. So there's, with the uncertainty there, that's why the static budget is our best guess and what the goal is for the company for the year. However, that does not usually occur. We usually miss the master budget to some degree, whether in the positive sense overall or overall in the negative sense. But the flexible budget is what we would have created if we knew exactly how many units we were going to sell. So calculating the flexible budget based on the units sold, the selling price is going to be the same as we use for the static budget. And each individual variable is going to be the same as we budgeted per unit in our static budget. Whether it's direct materials, direct labor, manufacturing overhead, variable administrative and marketing costs, anything that's variable is going to maintain the same cost per unit in the static budget as it is in the flexible budget. But the only difference between the two is the static budget is based on what we predicted to sell at the beginning of the period. In the total amount of the flexible budget, we're going to take that same budgeted unit variable cost and multiply it by our actual units to get the amount we should have budgeted if we would have known exactly how many we were going to budget or how many we were going to sell. So how do we do this? We do this in 3 steps. Identify the actual quantity of output, calculate the flexible budget for revenues based on budgeted selling price and actual quantity of output. Then we calculate the flexible budget costs based on budgeted variable cost per output unit times actual quantity of output, and then we carry over our budgeted fixed costs. Now let's take a look here at Webb. And Webb is a company in your book, Webb company. They manufacture and sell jackets. The book gives you that they're budgeting to sell each jacket for what, $120. And let me go ahead here and get out my tool so we can go ahead here and type this. And we can confirm that based on the amount of the static budget. How do I get my total revenues? Well, if I don't know the information on a per unit basis, if it's not given to me for whatever reason, which in the book it does, but if it's not there, then I can simply take my revenues of $1,444,000, divide that by the number of units we budgeted to sell, and that would give me my $120. So I've got so I'm just going to type in over here my budgeted sales price of $120. Now, what did I budget for variable costs? Well, let's take a look at our direct materials, direct manufacturing labor, and variable manufacturing overhead. So let's take a look at direct materials. Now, in our book, we're told that those costs, direct material costs, were what, $60 each. So $60. What about direct manufacturing labor costs per unit? We're told that on the cost per jacket, that amount is $16. Overhead, we are told that that amount is per jacket $12. Now, one thing we should remember, these are the budgeted inputs per unit created or per unit of output. This is not the cost of materials per unit of material. For example, and let me just go up here and make a different illustration here. Let's say I make bookshelves, and each bookshelf requires let's say 10 board feet of lumber, of wood. Each board foot, let's say it's a 450, cost is $4.50 per board foot. How much is going to be the amount of direct materials per unit of output? Well, it's going to be $4.50 times 10 equals what, $45 of direct materials per unit of output. The total amount of direct materials per unit of output is what's going to be represented over here in our static budget when we talk about direct materials per unit. But is that the same thing as my cost per unit of material that's needed? No, it's not. So I just want to make sure I make that distinction for you that this is not per cost of individual unit of direct material, but the total cost of direct materials per unit of output. Okay. Then we have our contribution margin here. And then from that, we subtract our fixed costs to get our operating income, just like we do in a normal contribution margin income statement. Now, my fixed costs, remember fixed costs we want to look at in total. Why? Because it deals with capacity. My capacity is not going to flex or change just because I use less warehouse space. For example, if you try to get out of paying some of your rent, and let's say your rent's $500 a month, and you tell your landlord that you only spent 15 days out of the 30 days of the month in your apartment, then he should give you a 50% break in your rent. Is that going to happen? Probably not. Because you're paying for the amount of time or the capacity to stay there for that full 30 days. Whether you utilize the capacity or not, it's not the issue. The thing is there with the rent, you're paying for that time. Same thing with warehouse costs. You're paying for the capacity of using this whole warehouse. So when you're renting a warehouse, when you're paying supervisors, whether they work 40 hours a week, whether they work 60 hours a week, you're paying them a fixed amount. That amount's not going to change. So that fixed manufacturing cost is going to be dealing with capacity. And we'll actually deal with capacity in a couple chapters from now. Next chapter and then the future chapter. So our focus right here is going to be on the flexible budget variances, sales volume variances, and just dealing with the direct costs. But let's go ahead and now illustrate the flexible budget. My flexible budget, remember, I said it's going to be based on the actual number of units sold, but it's also going to be multiplied by the budgeted amount that we had originally planned for. So for example, in my flexible budget for revenues, I'm going to take my actual number of units sold, 10,000, and multiply that by the budgeted amount of my sales price I was planning on selling it for to get me my flexible budget of revenues. Same thing with direct material costs. I'm going to take my cost per unit of output, $60, and multiply that by the actual number of units sold. $60 times 10,000 gives me $600,000. And that's my flexible budget for direct materials. What about direct manufacturing labor? Well, I'm going to take my budgeted cost of direct manufacturing labor per unit, $16, multiply that by my 10,000 units sold, and I get costs of $160,000. My variable manufacturing overhead was assigned at $12 per unit. And on a per unit basis, $12 times the actual amount I sold, $120,000. And then for my flexible budget, I can subtract my flexible budget from my flexible budget revenues. I can subtract out my flexible budget amount for direct materials, direct labor, variable manufacturing overhead to get my flexible budget for contribution margin. Then I have fixed manufacturing costs at $276,000. Again, that's not going to change, but it is. But we still want to account for that. So there should be no change because that's dealing with capacity. So for budget purposes, there should never be what we're going to see here, a variance or a difference between the flexible budget and static budget. And then we have our actual results over here. Now let me get out of this here and go back here. And in this static budget variance we talked about a few minutes ago, there are two main variables that were different between the static budget and actual results. What were our two variables? Well, one was level of output. We had a difference in the level of output. 10,000 units we actually sold of jackets. We budgeted for 12,000. The other difference is our actual sales price and our actual cost for direct materials, labor, and variable manufacturing overhead, as well as fixed costs, were different on a per unit basis for variable costs and in total for fixed costs. So we have a per unit basis difference, and we also have an activity level basis difference. So we got two different variables involved. So really, doing a static budget variance, it doesn't tell me that much. For example, let's take a look at revenues. I budgeted for 12,000 units sold, right? And I only sold 10,000. My budgeted revenues were 1,440,000. My actual revenues were 1,250,000. But that makes sense because I was selling less. So I anticipated on selling less. I anticipated on making less if I sold less. But was that my price per jacket? No, my actual price per jacket I sold it for was $125. I won't know though until I do a further analysis here. So the static budget variance here is comparing apples to oranges, which is why we want to do a flexible budget, because now I can isolate two other variances that comprise or are added to or complement each other to compute the static budget variance. First of all, we have the sales volume variance, and the only reason it has a variance is because of the level of output. The flexible budget variance says, okay, we've evened out the output, so now let's see, did we actually generate more revenue per unit? Did we actually incur more direct materials, direct manufacturing labor, or variable manufacturing overhead costs on a per unit basis? Then when we're looking at fixed manufacturing overhead, it's saying how well did I predict my costs and how well did I manage capacity? So, and we'll see that capacity here in a little bit. However, for the flexible budget variance for fixed manufacturing costs is purely on the amount spent. And in the next chapter, we'll deal with fixed manufacturing costs and variable manufacturing overhead. So we're going to deal with manufacturing overhead in its entirety in the next chapter. So we just want to focus on direct materials and direct manufacturing labor. But at least now we know how to compute the flexible budget. And then, in the same manner that I computed my static budget variances, I'm going to compute my static budget or my variances for the flexible budget variances over here, the difference between my flexible budget, my actual results, and the sales volume variance, the difference between my flexible budget and my static budget. Okay. Now let's talk about the sales volume variance. We mentioned it a minute ago, but the difference between the sales static budget and the flexible budget amounts is the sales volume variance because it arises solely from the difference between the actual volume and the budgeted volume. What do we mean by that? Well, remember that I created my static budget for 12,000 units at the beginning of the year based on an assumed sales price of $120 per unit. My flexible budget was also based on that same budgeted sales price per unit of $120. So what's the difference here? The difference here is the level of activity. So when we say that the sales volume variance arises solely because of the level of activity, that's because only the activity level has changed between these two. The budgeted input amounts for cost and selling price have remained the same. So now let's talk about some possible reasons we might incur an unfavorable sales volume variance. Maybe we failed to execute the sales plan. Maybe there was weaker demand. Maybe we had some aggressive competitors taking market share. Maybe we had maybe just the market just chose they wanted to go a different way. Maybe we had quality problems. So there are some reasons why we may have had some sales volume variances. Now, flexible budget variances provide even more information than we get from level 2. Now, all product costs can have level 3 variances. Direct materials and direct labor will be discussed next. So let's go back here before we do that, and let's talk about the flexible budget variances here. The flexible budget and the actual results have what in common? They're both based on the number of units sold. So what's the difference then? The flexible budget amounts arise not because of a difference in units sold, but a difference in sales price per unit that we were actually able to achieve versus what we planned on achieving, our budgeted sales price, and the direct material and the cost incurred, the total cost spent is going to differ on a per unit basis than what we had budgeted for. So this is where we actually want to start seeing the flexible budget variances. While the sales volume variance is important, we really want to get into the nitty gritty here and take a look at our flexible budget variances. And one more thing to note here, my static budget variance of 93,100 is unfavorable. It is a combination of or a netting effect of both the sales volume variance and the flexible budget variance. So once we net the effect of those, and if they're both unfavorable, then we add them together. If one's favorable and one's not, we take the difference between them, and then we see which way it is, if it's unfavorable or favorable from there. So let's take a look here. Now, the level 3 variances give a detail to our level 2 flexible budget variances. And instead of simply identifying the difference between the actual material cost and budgeted cost, We're now going to break that variance down between the actual cost per unit of materials. We're going to break it down into two more components: a price variance component, or the difference we paid in price versus what we budgeted to pay on a per unit basis for either like square foot of material or per board foot, if we're making shells or wood products, things like that. And the efficiency component which deals with how much material did we use, or how much labor did we use compared to what we had planned to use. So let's take these basic formulas here. These basic formulas for price variance for our materials and labor is going to be the actual price of the input on not on a per unit basis, but on a per unit of materials basis. So let's say that we buy materials. It buys square footage of materials to make jackets. Now that price is going to be what we actually paid per unit of material, not per unit of output. So I'm taking my actual in price per unit of material, subtracting that from the budgeted price of the cost per unit of input or cost of material, and then take the difference between that and multiply that by the actual quantity of input. And then we're going to see our efficiency variance. It's going to take the total quantity of input used to make each unit of output minus the budgeted amount of input or budgeted quantity of input allowed for actual output times the difference between those two and multiply that by the budgeted price. And that will give us our efficiency formula. So let's take a look here. Now, when we're going to lay it out, and sometimes it's really good to lay it out just the way the book has right here. And we can lay out here. Let's take a look at materials. Let's lay it out in these three categories here. Our first category is going to be actual cost incurred, which is our actual input quantity. How many square yards of material did we actually use? Times the actual price paid, which was $28 per square yard. And that gives us our actual cost of materials used, $621,600, which we see that right here on the level 2 analysis. Now the flexible budget is going to say on the right here, the budgeted input quantity allowed for actual output times the budgeted price. So what do we mean by that? Well, the company, budgeted for 2 square yards of material, and based on that 2 square yards of material, if we made for a flexible budget 10,000 jackets, then our flexible budget input quantity allowed is going to be 20,000 square yards of material, 2 square yards per unit times the 10,000 units actually sold, and we multiply that by the budgeted price of $30. And that gives us our flexible budget, which we see over here on this screen. Now let's take a look at the actual input quantity times the budget price. So I'm going to take my actual quantity I actually used and multiply that by my budgeted price that we find in the flexible budget here. And that gives me $666,000. Now, these numbers here, not only for now, I've got the difference between here, the difference between this and my actual cost incurred is going to be my price variance. The difference between my actual input quantity times budgeted price and my flexible budget is going to be my efficiency variance. And we can actually compute that using those same formulas here. If we use those same formulas, we're actually going to get the exact same amounts here. And I actually illustrate that on one of the exercise videos. So the efficiency variance and the price variance combined give me my total flexible budget variance for direct materials of 21,600. And that was unfavorable right here, 21,600. So using this setup will not only allow me to now easily compute my price and efficiency variances, and I can also do that based on information instead of having to go through all that. Now, there may be times I do want to go through all this, but if I don't need to, certainly, then I want to just use my price variance formula and my efficiency variance formula. Let's take a look at direct manufacturing labor. Our actual costs incurred, we're going to look at this left column here first. Actual costs incurred, which is our actual input quantity, the number of hours we used of direct labor, times my actual cost per hour of direct labor, will give me my direct labor cost of $198,000 that I actually incurred. And that agrees with what we saw over here. Now, with this here, we're going to figure out my flexible budget. And how do I compute my flexible budget? Well, my flexible budget is going to be based on 10,000 units sold, and it requires 8/10 of an hour to make each jacket for direct labor. And then we're going to take that 10,000 times 0.8 to get the number of direct labor hours needed to make 10,000 jackets. And then we're going to multiply that by our budgeted price, and we have $160,000 here. And that concurs with what we determined over here. So now I can figure out my actual input quantity here in this middle column, the number of hours I actually used, and multiply that by my budgeted price, which was $20. I get $180,000. And remember, I said earlier that the difference between this column here and my actual costs incurred, this left column here, is my price variance. And I can confirm that by using my actual price variance formula. Then we have our efficiency variance here of $20,000, which is the difference between our actual input quantity times budgeted price, and the difference between that and our flexible budget dollar amount of $160,000. Now, altogether, my flexible budget variance for direct labor was what? It was $38,000 unfavorable. Now we've isolated that and found out why. $18,000 of it was due to spending more per hour of direct labor. While this $20,000 here says we used $20,000 more of direct labor. Why do we care about getting these variances? Well, we want to know where we're going as far as the price and the efficiency variance, because if this is unfavorable, why, or favorable, it should ask us, why was that price variance there? Did we pay more? In this case, we did pay more. We paid $22 an hour for direct labor, and we were only budgeted for $20 an hour for direct labor. So why did we pay more? Here, I want to ask the questions, why did we use more direct labor hours? Did we have machine breakdowns? Did something else happen? We need to know. And again, my price variance, 18,000 unfavorable here, plus 20,000 unfavorable here. When we net them together, that will equal our flexible budget variance. What's another reason I might like this setup here? This setup here, when I get all this, will also help me through my journal entries, which we'll talk about in the next video. But this is going to help me with my journal entries. So probably the best way to do this is to go here. That way I can actually calculate my price and efficiency variances, and that I can easily, and that I know where and how and what my variances are that I'm going to allocate. And we'll look at that next time. So here's just an overview and a summary of the variances here. And the variances we have here are static budget variance. And remember, our static budget variance we broke down into our flexible budget variance for operating income and our sales volume variance for operating income. There's no more breakdown of sales volume variance at this point, but our flexible budget variance for operating income is $29,100 unfavorable. And what's going to contribute to that? Well, our selling price variance, our direct materials variance, direct manufacturing labor variance, variable manufacturing overhead variance, and fixed manufacturing overhead variance. So all those variances we saw here contribute to the operating income variance of $29,100. All these variances, the ones we didn't look at today and the ones we did, they all contribute. So now we need to break down the direct materials variance and the direct labor variance into their price and efficiency components. Again, a price deals with how much should we pay on a per unit basis, let's say of like direct labor hour, per hour of direct labor, per yard, per square yard of material, of cloth, whatever. And efficiency deals with how much or how little, how well did we utilize that labor or that thing or the material that we bought. So that's where we get our direct materials and our direct manufacturing variances from there. So now next time we're going to examine those variances, and then we're going to use this chart here to get a sense of how we can create our journal entries, and then go ahead and go from there and actually talk about management with variance analysis. So this is Leroy Meadows. Thank you for joining me. Have a good day.